Hey, what's up, everyone? This is a trade recap and review for Mr. Chris here in the group. He went long at 58.99 and stop here at 50.94. Trying to get him for a long momentum trade. Stop and lost about $250 per contract times contracts. That is, unless I'm reading your post wrong, but I think that's what I'm saying. You didn't identify the stop. I'm just using math that you gave to identify the stop, which is good because it did go another 6.5 points lower, which would have been extremely costly, right? So here's really a couple reasons why I wouldn't have taken this. First off, you're very far extended from the low of the day. I know that you might be thinking of it in terms of legs or maybe just in this push, but this is a midday lunchtime push. That is sometimes on low volume. Get a higher volume rejection here over the 5900, which is whole century number, everything. It's more likely to play the short. And you mentioned, your gut feeling to play the short off 02, which seeing how the chart was that extended and how it had broken a total new session high, I'm not sure, what got you thinking against that. Maybe just trying to stick with CBC, which is fine. But if you're trying to stick with CBC, that usually, especially with the back testing, the best entries come from following candle as long as you influence, or in this case, the second candle right after the CBC candle flip, right? So what I'm identifying here is, and you mentioned being a supply and demand trader, that this is an intraday supply zone here that the bears try to defend. Ultimately, when the bears can't break this lower from this zone and they get pushed over, now they're stuck sellers who want to get out as stuck buyers, right? So if we mark the this is the candle here where potentially we would want to see a 2 minute dip, but we can even just look at these two candles for their pullback. So you see after 10-minute CBC pushes and flips to green, in this area right here, you're getting your 2-minute 20 EMA taps, right? Multiple taps. And this is really where the CBC strategy shines. It's not up here after you're very far extended even from the 2-minute EMA, right? Extension like that off the 2-minute EMAs often either means that we're going to pull back or that we're going to drift until it catch up. So you see this big push, probably a bit extended, comes down, drifts sideways, barely floats up. They're getting closer, it pushes again, drifts sideways, pushes up. Now in this case, it's just turning down. The other thing I just want to say too is that even if you're just laser focused on the 2-minute chart, and I know sometimes that can happen when you should still be scanning the 10 and other higher time frames. On a 2-minute, this is alarming, right? So you have a candle that breaks the new highs, breaks the session high, sellers on the top. Then you can't push any higher and you close a little bit lower. Okay. Then again, you close lower. So now your 2-minute CPC is flipping bearish. And if you look, it's just going to keep coming down. When you get this candle, right, the next candle opens and it pushes up halfway into that body. When that candle turns red and ultimately flips down under this candle, you have to know that it's going to keep coming down even lower. And that's unfortunately right where you got in. So I think a little bit of overeagerness to get in a 2-minute 9 EMA candle was really part of what did this trade in, versus waiting to see if buyers were going to step up and hold the 20. Because even if you entered in this area or right here on this second tap, like, yeah, it doesn't give you a whole lot, right? Assuming that it just goes to here, you barely get, a point if you're lucky, but, you can have less risk where you could, you would see this would be about 2 points versus 5, right? And you're trying to see them hold, but even then you can tell the CBC has already flipped bearish. And on the 10-minute, I believe the 14, about the 20 candle, it hasn't flipped bearish yet, but it's about to. And then so you can just see how that's drifting downward, and the 10-minute EMAs being that far, it's going to drift up. If we go over to VIX, some things that maybe cause a little bit of confusion. Let's look at the VIX and ES side by side here. So you mentioned VIX having a little bit more to go to fill the gap at 1830. Well, there's not a gap at 1830. That's just like a wick right here. The gap that's like first and foremost is the 4 p.m. close from the prior day. So you can see that on this high of day push here at 1350, same here at 1350, that's when we break this dark blue line, which is previous day low and the close at 4 p.m. So we already filled the gap. On filling that gap, it does move lower. And when this candle starts to turn green and the ES candle starts to turn red or gray in my case, that signifies that you're probably near the top. And it either, again, is going to drift sideways, but doesn't mean it's going to be a good short, or it's going to go back to the EMAs. And then sometimes it goes back to the EMAs and then more. I mean, each setup is going to be a little bit different, but this is for sure like a no long signal, right? And I would encourage you to just, if you want to throw VIX and looking at the VIX into your strategy like I have, you really have to back test it. And look at it, as things are playing out, but also what potentially out, why it would, right? So let me know if you have any questions, and